How do advanced volatility metrics set dynamic stop losses? Imagine trying to catch a ball in a storm versus a calm day. The weather changes how far you should stand back to avoid getting hit. That's similar to how traders use volatility to set stop losses. Instead of fixed dollar amounts or percentages, advanced volatility metrics help adjust stop-loss levels based on current market conditions. This makes risk management more flexible and effective. Volatility measures how much an asset's price swings over time. There are two main types: historical volatility, which looks at past price movements, and implied volatility, which reflects what the market expects for future swings. For example, the volatility index, often called the VIX, shows how much traders think the market will move in the coming months. Realized volatility is calculated over a set period, like 30 days, to see how much prices have fluctuated recently. Beta measures how much a stock moves compared to the overall market. Traders use these metrics to set stop losses that adapt to changing market conditions. One common tool is the average true range, which calculates the average price range over a specific period. If the average true range widens, indicating more volatility, the stop loss is set further away from the current price. This prevents normal price noise from triggering a stop. When volatility drops, the stop loss tightens to protect gains. In options trading, implied volatility is especially important. When implied volatility is high, it suggests larger expected price swings. Traders set wider stops to avoid getting stopped out during big moves. When implied volatility is low, stops are tighter because the market is calmer. More advanced methods use algorithms that constantly update stop-loss levels based on real-time volatility data. For example, a trader might look at the last 90 days of realized volatility to decide how far to place a stop. If recent volatility has increased, the stop moves further away. If it decreases, the stop tightens. This approach helps keep risk within limits and avoids premature exits or large losses. In stock trading, traders often use ATR-based stops that adjust daily. They might also use volatility channels or bands derived from historical or implied volatility to define stop zones. Trailing stops that move with volatility changes are popular because they tighten in stable markets and loosen in volatile ones. Combining volatility metrics with other technical indicators like the relative strength index can refine exit points further. This dynamic way of setting stop losses aligns with the core ideas of risk control and capital preservation. It helps traders avoid being stopped out during normal market noise while protecting their capital during sudden adverse moves. In options trading, where price swings can be more intense, using volatility-based stops is especially helpful. It manages the risks of leverage and time decay, making your trading more adaptable and safer.